Well, welcome everyone. Thank you all so much for coming. As Stephanie mentioned, we're just going to be going through some tax planning for you guys. So tax planning basics, this is talking about saving and deferring tax. And when we think about that, we want to think about timing. Now, what does that mean? First, we have to think about what's our goal when we're trying to save tax. A lot of times we think, I want to pay zero tax, but when our businesses are doing well, we're bringing in income, unfortunately, we're probably going to have to pay some tax. So what we want to think about instead is how can I spread my tax throughout the years and not be hit with a lot all in one particular year. So we're going to show you some different strategies, some things you might be able to implement before the year ends in 17. So what might you be able to time? Well, income, you can think about, are you expecting bonuses? If you have self-employment income, you can kind of manage that. Is there a project you might want to postpone until January? Retirement plan distributions, if that's your situation, are you taking those? Your deductible expenses, that's state and local income tax, property tax, your charitable contributions. I know a lot of you probably make donations. When are you going to make those? Are you going to start making some before the year's up? And then if you have income properties and you're thinking about selling, you can do an installment sale to kind of spread that income, or a like-kind exchange, defer that to another year. AMT, so this is a completely separate tax system from your regular income tax. And not everyone is affected by this, but if you do, it could cause some pain having to pay it. So just some triggers. If you do have those state and local income tax deductions, or if you're taking accelerated depreciation on your assets, you could be subject to AMT. What you want to do is definitely talk to your CPA or tax advisor, especially if you've ever been subject to AMT before, just to be aware of that, kind of plan for that. Now home sales, they say it's a seller's market, so if you're thinking about selling your home and you're worried about paying tax on the gain of that home, there's actually an exclusion. So if you sell your house and you have up to $250,000 in gain, you don't have to pay tax on that if you're a single individual. If you're married filing joint, that bumps up to $500,000. And the exclusion is also on net investment income tax, which Adrian's going to touch on later. The flip side of that, however, is if you sell your home at a loss, you can't deduct the losses. So don't have to pay tax on the gain, but if you have a loss, unfortunately, you're not able to deduct that. And if you have a second home, like a vacation home, the exclusion doesn't apply. So if you have gain, you'd have to pay tax on it. So you might want to consider converting that home into a rental property first before you sell it. Energy-related breaks, there's more on this in your packet, but we just wanted you to be aware that there were some other breaks like wind, fuel cell. Those have all expired in 16, but there's still solar. So if you install solar, you can take a 30% deduction on the expenses related to that. And that's been extended through 2019. Okay, charitable donations. This is a big one. A lot of you guys make donations to be able to help reduce your income. What you need to know is that you need support for those donations. So if it's under $250, you can have like the canceled check or a receipt. That works. If it's over $250, you need a letter from the charity stating how much you donated, and it needs to be dated at the time of the donation. This is really important because if you are ever subject to an audit from the IRS, this is something they look for. We actually do have a client going through this right now and having to scramble and find all that support, so make sure if it's over $250, you have a letter dated at the time of the donation. And there's just a warning here. Charitable deductions are allowed for AMT if you're subject to that, but it might not be as beneficial. Health savings account. So this is a really cool thing. We have these at our firm. It's usually provided by your employer, and it's a plan where you can set aside tax-deferred money to use for your medical expenses, prescriptions, co-pays, things of that nature. And then you can actually deduct the contributions that you put into that account. And so these are the limits. If you're over 55, you can add an additional $1,000 annually into that account. Just other itemized deductions. There's a standard deduction and then there's itemized deductions. The thing you want to think about is, will it be beneficial to me to itemize? And some examples of that are like your charitable donations. You can actually deduct your tax preparation fees, like fees you pay to your CPA, your local taxes, things of that nature. And also a big one that many people use itemized deductions for is their mortgage interest. That's another one. But what we want you to know about this is that it's usually limited. So for example, it says many miscellaneous expenses are deductible only to the extent they exceed 2% of your AGI. So for example, if you make $100,000, you would have to spend over $2,000 to get a deduction, and it would be whatever's over that $2,000. So if you spend $2,500, you'll be able to deduct $500. Okay, the next section here is family and education. Similar theme, we want to think about timing, not just saving tax dollars, but if you start setting aside money for your kids now, it's going to be able to grow a long time. And then also, even if you don't have kids, there's certain type of accounts you might be able to set up for your unborn children, if you have grandchildren, just thinking about ways to save money by deferring some income to them. So we're going to talk about a couple of those ways. First way is an IRA for teens. So that's the benefit here, is that it's many years of tax-deferred growth. If you set this up for your child, they're going to be able to accumulate a lot of money over time, setting them up for success in their future. And also, so they can put money in themselves from what they earn. There's a limit on that, 100% of their earned income. Or you can actually gift money to them and put it in the account that way. So you can defer some of your income and put it into this account for them. Next thing is 529 plans. This is a type of tuition saving plan. If you want to save money for your kids' college, that's what this is for, and it's really great. There's a lot of benefits. We actually have a couple of people at our office that have these set up for their kids. And the good thing about this plan specifically is that there's no beneficiary age limit, so even if you have children over 18, you can still have this plan for them. You control the account even after they turn 18, so you can dictate where that money's going for them. And then it also rolls over to other family members. So say you have your first child, you think it's going to go to college, they end up taking a different path, you can roll that money over to your next child and so on. And then also, you can front load 5 years worth of the annual gift tax exclusion, and that's $14,000 a year. So if you really need to defer some income, 5 times that is $70,000. You can put all that into an account at one time. And now Adrian.
So investments come in many different forms, from common stocks to investments in properties to just direct business investments. It's definitely something you want to consider in your planning with your investment advisor, your tax advisor, even your wealth planner. Again, key thing with investments is plan, especially for when you sell. So first thing to note with investments are capital loss carryovers. So capital loss carriers are if you have capital losses that exceed your capital gains, you can deduct up to $3,000 annually if you're married filing jointly, and it's $1,500 for married tax. $1,500 for single individuals, and that's on dividends and ordinary income, and those can be carried over indefinitely, essentially. So let's say you sold stock this year at a $50,000 loss. This year you can deduct up to $3,000 of that loss. But that loss can indefinitely be used going forward. So if you have a gain next year, you can use $3,000 of the $50,000 loss you had this year on future years. The net investment income tax, kind of going back to the alternative minimum tax, which we talked about earlier. The NIT tax is essentially an additional tax on top of your taxable income. And basically, the NIT tax is 3.8%. It applies to the lesser of net investment income or the amount by which your modified adjusted gross income exceeds the thresholds above. Again, this is an additional tax, and there are different ways to avoid it. Again, the big key stressor in avoiding the NIT tax is tax planning with your investment advisor, with your tax advisor. The biggest thing is, there are different investment categories that might not qualify under the NIT tax. There are different strategies in terms of timing of when you sell, taking into consideration the different thresholds above. Maybe you might qualify one year and another year you might not for this NIT tax. But again, if you don't plan for it, it could be, a last second, oh no, I got this extra 3.8% tax on an investment I sold this past year. Definitely something you want to plan for. And again, there are different tax strategies you want to talk about with your investment advisor. Next up, we're going to talk about businesses and self-employed individuals. Again, to tackle the 2018 tax planning challenges head on. This has a number of different kind of high-level categories we're going to talk about. Biggest thing is, if you're starting up a new business or you're self-employed, what type of tax structure are you going to set up with that business? And there are a couple of different forms you can take. Again, something you want to plan before you start a business with your tax advisor. So the first thing is 3 depreciation-related tax breaks. And these have to do with essentially improvements you're doing on your business. So the first tax break you could get is for 50% depreciation, where basically you're getting an additional first-year depreciation allowance for qualifying leasehold improvements. I know that this specific tax break is going to be phased out over the next couple of years. I know in 2019 it's going to go down to 30% from 50%. A second tax break you can get is the Section 179 expensing. This basically allows you to expense the full amount of capital improvements, and it tends to be specific in restaurant and retail improvement properties. So let's say you own a restaurant and you want to put in a brand new walk-in refrigerator, and that cost you $100,000. If that were to qualify under Section 179 expensing, you could expense the full $100,000 of that amount in the current year. So it's definitely something you want to plan for. Especially since we have 2 months left in this year. If you are thinking about making improvements to your business this year, you might want to talk to your tax advisor, see if this would qualify, because you could take this as a deduction for 2017's tax return. Third tax break related to depreciation is accelerated depreciation. Basically, this allows for a shortened recovery period of 15 years for qualified leasehold improvements. And again, this is mostly more specific to restaurants and retail improvement properties. Other asset-related issues. So a few years ago, the IRS issued final regs for tangible property, basically saying any costs incurred on incidental repairs and maintenance can be expensed and immediately deducted, similar to the Section 179 deduction we just talked about. Within that new reg, there were de minimis safe harbor rules, basically saying for smaller expenses that you're using to make improvements on your business, I believe it's up to $2,500 per invoice per item you can use as a deduction if you elect the de minimis safe harbor rule. And that's something if you elect, you have to carry forward into the future. So instead of capitalizing these de minimis kind of smaller costs, you can just expense it in the current year if you elect this. Another thing to note for other asset-related issues is a cost seg study. So a cost segregation study is something that you can do for your business. It basically identifies property components and related costs that can be depreciated faster. The problem with the cost segregation study, it's probably not something that you can do for this year's tax year. It definitely requires a lot more planning. You need to hire specialists who can put together a formal analysis of all of your property components and related costs and see what can be depreciated faster. So it's something you have to plan for way ahead of time, but it can have significant benefits down the line. Definitely something you want to talk about with your tax advisor. Vehicle-related deductions, something not everybody knows about is you can deduct actual out-of-pocket expenses on vehicles, or you can elect to deduct mileage. So this year it's 53.5 cents per business mile. I know my mom, she is a realtor. She is constantly traveling from town to town, showing houses. She's constantly on the road, and she uses that mileage deduction annually. Biggest thing to note with the mileage deduction is you have to absolutely keep track of your actual business usage mileage. It is incredibly important if you ever get audited by the IRS. They're going to want to see support and documentation to back up your mileage.
How much does that number change over time, the 53 cents?
So it actually went down this year from 54 cents to 53.5 cents. So it does adjust annually for inflation, but this year it actually went down the half a cent. So like I was saying, definitely important you want to keep track of your mileage, especially for business use. I know our firm has an application that you can download through the App Store on your phones. And basically you download it and it's a mileage tracker. So anytime you get into your car, you use it for business purposes. You just enter in how many miles you had gone for that specific reason. It records it. And then later on down the line, when you want to see how many miles you actually tracked for business use, you can export it into like an Excel spreadsheet and you can see actually how many miles. And that's pretty good documentation for IRS tax purposes. You definitely want to be specific for what the business use was. And then again, the big thing is, so if you do have a vehicle, if you're using it for both personal and business, you want to segregate the two for when you're using it for personal and when you're using it for business. You absolutely have to keep track of that, and you need to have like substantive documentation if you were to ever be audited by the IRS. And there's one warning here. So the depreciation limit is reduced if the business uses it less than 100%. And if the business uses 50% or less, you can't use that Section 179 expensing. Just something to take note of. Affordable Care Act, the play or pay provision, this provision basically says if you are a large employer, and the definition of a large employer is basically if you have at least 50 full-time employees annually, you are required to provide a minimum essential coverage of healthcare to your employees. If you do qualify for this being considered a large employer and you're not providing healthcare to your employees, you could be subject to penalties come tax time. They could be pretty significant too. Biggest thing to note with this is if you do have a payroll provider or you do have a health insurance provider, they should be able to tell you whether you should be providing insurance to all your employees. So it's definitely something you want to talk to with them, and even your tax advisor should be able to tell you whether or not you should be providing the minimum basic coverage. So talking about business structures, if you want to start up a new business, it's important to take into consideration the business structure you're going down because it could have significant tax implications. So the one structure we're going to talk about, one out of the two, is the flow-through entity or sole proprietorship. Basically, flow-through entities have one level of taxation where business income is the owner's income, and any losses on that business is going to flow down to benefit the owner. And generally, the top individual tax rate is 39.6% for sole proprietorships or flow-through entities. The other type of business structure you can set up are C corporations. For C corporations, there are two levels of taxation. One is the income on the business, and the other is the actual dividends coming out of that business. And then losses, they don't flow to the owner for C corporations. They're done at the corporate level only. And the top corporate tax rate is usually about 35%, with dividend rates being about 20%. So there are definitely different tax implications when setting up a corporation or a sole proprietorship or a flow-through entity. Something you want to consider with your tax advisor before setting up these structures. Self-employment taxes. So if you're self-employed, something not everybody knows is that you're required to pay both the employee and employer portion of the Social Security tax and Medicare tax. And there are certain thresholds that go along with this. But basically, it's something you want to keep in mind if you are self-employed. If you're not paying that employer portion of it, come tax time, you could wind up having to pay the government a significant amount of money. Other above-the-line deductions to note for self-employment taxes, and when I say above-the-line deductions, these are deductions that adjust your modified adjusted gross income. One, if you're self-employed, you can take 100% of health insurance costs up to net self-employment income. You can take contributions to a retirement plan as a deduction, and then also you can take contributions to a health savings account, which we talked about earlier. Basically, it's just important to know if you're self-employed, you do have additional deductions you can take, something you want to talk about with your tax advisor. Also want to make note that you do have to pay the employee and employer portions of your taxes. Next up, we're going to talk about retirement.
Okay, so just a couple of quick slides here. We just want you to think about when it comes to retirement, when are you going to save? How are you going to save? There's a lot of different type of accounts out there that you can set up. Some that take out the tax now, some that take out tax later. So another thing that you can talk to with your financial advisor about, what's the best strategy for you? So what to know about retirement in 2017? If you are self-employed and you don't have a retirement account set up yet, this is actually something you don't have to set up by December. If, February rolls around and you're like, oh, I think I need to make some contributions, you can set that up through the time you file your 2017 tax return. The other thing to know is there's different age limits for distributions. 59 and a half, if you're approaching that, if you take distributions before that age, there's a 10% penalty, so make sure and hold out on that if you can. But by the time you reach 70 and a half, you have to start taking distributions then. And then here are the contribution limits for 17 and 18. As you can see, they don't really change much year over year, but that 401k line is going to increase by $500 in 2018. The other thing to note is that there's catch-up contributions. If you're over the age of 50, this is an additional amount you can contribute annually. Okay.
Is there a limit on your income to be able for some of those? I think if you make over a certain amount, you're not eligible for some of those.
Yeah, I'm not sure about the specifics of each plan, but that would definitely be something to talk about with your CPA. Which plan is going to be best, because you don't want to sign up for that if you're not eligible. So.
Next, we're going to talk about estate planning. Estate planning in a tax sense, and then also estate planning from if you own a business, a succession perspective. So what's going to happen to your business once you pass? And I would say biggest thing with estate planning is do it early, get the planning done, you get it over with. Have a family meeting, with all your beneficiaries. Have them all to come together with your attorney, with your CPA, kind of lay out what the plan is. It definitely makes for a smoother transition when that happens. I know for myself, my parents set up a trust, and they just had a difficult conversation with myself and my sister where they're making me the executor of the trust just because I have a financial background and she doesn't. And it was a difficult conversation. I think she's a little bit relieved that she doesn't have to have that responsibility on her shoulders to kind of manage that trust once it comes down to it. But I'm glad we had the conversation early. Everything worked out in the end, and it's definitely something you want to consider. So the estate tax basically is 40% rate, and there is an exemption on estate tax. So if your total assets total 5.49 million, anything above that subject to the estate tax of 40%. Anything below that is not subject to it. Definitely something you want to take into consideration. I think most people don't realize that they're up against that threshold, and there are definitely tax planning strategies you can put in place if you hit up to that 5.49 million. Definitely you want to talk to your tax advisor if you feel like you're probably close to it, because I know you definitely don't want to be paying 40% on that tax once it passes down to your beneficiaries. So one of the planning strategies for estate planning is gift tax. So there's an exemption on gift tax up to $14,000 per recipient. So you can give $14,000 to an individual and it won't be taxed at all. And if you're married filing jointly for a couple, it is $28,000. Again, if you're coming up against that threshold for the estate tax, this might be a good tax planning strategy where you're gifting your beneficiaries, $14,000 annually prior to your departure, and that might bring down your total assets below that $5.49 million threshold. Definitely something you want to talk about with your tax advisor because it's a great strategy. There's something called a generation skipping tax. Basically, this is a transfer of an estate to someone more than one generation below the original owner. So the common example is grandchildren. If you know that your children are well off financially, they don't really need a benefit from your assets upon your departure, it might be smart to set up your estate to go to your grandchildren because there is a tax exemption there. Definitely something to consider. You could set it up for their education, anything you want, a down payment on a home one day. Definitely something that you want to consider if you want to avoid paying tax on your estate. There are typically 3 goals in estate planning when it comes to taxes. 1 is you want to minimize your estate tax. 2 is you want to minimize your beneficiary's income tax. And 3 is you want to minimize your own income tax. For the first goal, to minimize your estate tax, one of the things you want to do is you want to gift property with the greatest future appreciation potential. So you bought it, low, it's staying low, you think it's going to appreciate much higher in the future, and you want to bequeath that to your children because you think they're going to get that benefit. So that's one of the tax goals. 2 is you want to minimize your beneficiary's income tax. So to do this, you want to gift property that hasn't appreciated significantly while you've owned it. So let's say you own a piece of land and you've owned it for 3 years, and while you've owned it, your tax basis in it hasn't really appreciated much. If you give that to your children, there won't be significant taxes on that. So definitely something you want to consider there. And then also there's a third kind of strategy when estate planning, and that's minimizing your own tax. If you know that you've experienced a loss on, let's say, a property or stock, you might want to take advantage of that loss yourself in the current year, on your current year tax return. You definitely don't want to gift property that's declined in value because it has no real benefit.
Okay, and then these next coming slides aren't in your packet, but it's just some additional information we thought would be helpful. If you know anyone affected by the Northern California fires, anyone living in that area, the IRS actually issued an extension for the filing deadlines for those counties. So the individual returns were due October 16th, but it's been extended to January 31st, 2018. And this is also on the estimate payments. So normally that's due January 16th. They added a few more days there. So if you know anyone in that area, just pass this along to them.
So common kind of idea in everybody's mind is what's going to happen to taxes in the future. We have a new administration in place. So you want to talk a little bit about the tax law according to Trump. So far, no laws have been passed. A few weeks ago, the Trump administration released an overall framework of what they'd like to see the tax code go. And a couple of things to note in that framework is, one, that tax brackets are going to collapse from 7 to 3, and there is potential for an additional top rate, highest income taxpayer bracket. Another interesting thing is standard deductions. As a part of their framework, they'd like to double that to $12,000 for individuals and $24,000 for couples. Itemized deductions under his framework are going to be eliminated. Alternative minimum tax, which we talked about, estate tax, which we talked about, the GST, which we talked about, those are all, he would like to see those repealed. The corporate tax rate is going to be reduced from 35 to 20%, and there's going to be potentially a new tax rate of 25% that would be created for pass-through businesses, so partnerships and sole proprietorships. Again, nothing has passed yet. We don't know if anything's going to happen in 2016. It does take a few weeks for these things to iron themselves out. Sometimes they don't iron themselves out due to the current political climate. And there is potential, so if they do pass it in 2017, they could make it retroactive to 2016. So if something does pass in January, February, it could be applicable to this year. I think the biggest takeaway from the overall framework is that it seems like it's very business friendly. From what they have put in place, it seems to be very pro-business in a reduction of taxes, increase in standard deductions, eliminating some of the deductions, the itemized deductions. So that's basically it, and definitely we'll see in the future what comes out of it. So that's our presentation. Thank you very much. We would like to open up the floor to questions if you have any questions.